The broadcast is now starting. All attendees are in listen-only mode.
Hello, everyone. I'm Michelle Hebert, Director of Communications here at Saney's, and welcome to another Lunch and Learn and our ongoing Financial Friday series. Saney's is excited to offer these sessions in cooperation with our corporate partner, AXA. AXA has a long-standing presence in New York, and a large portion of AXA's New York client base is built upon the work they do within the public education system. Through AXA, Saney's members can receive competitive insurance rates and a full array of retirement services, including a complimentary financial profile for Saney's members, which we urge you to take advantage of. It's a great benefit. Our AXA presenter today is Greg Ronenberger, a regional vice president and advisor from the Syracuse area. Now, before we get started, please note all participants are in listen-only mode and muted during the presentation, but we'll do Q&A after. So if you have a question, just type it in your control panel, in the questions panel, and we'll get to those questions after the presentation. And with that, I'll turn it over to Greg.
All right, thanks, Michelle, and thanks everyone for joining here. I was given the privilege of talking about taxes today, which is everyone's favorite subject, I'm sure. We love it, but there have been some changes to the tax laws recently that we'll highlight here a little bit. We will look at retirement income projection and see what the impact of income taxes has on that, and then look at some opportunities to hopefully limit or even eliminate. We can't really eliminate, but maybe limit the amount of taxes that we're paying in retirement time. And we're going to do all that in about 22 minutes, hopefully, so that we leave time for questions afterwards. So to get started here, advance, here we go. All right, so the new Tax Act, briefly, what the main priority was to reduce corporate tax rates because the government wanted to spur economic growth from the top down, so to speak, so that corporations could reinvest and create more jobs, things of that nature. And now that's all well and good. However, the tax cuts for the corporations is going to cost quite a bit of money. You see 1.4 trillion in revenue over the next 10 years. And while there were some advantages and will be some advantages to individual filers like ours, the other provisions, as you see, had to be what's called revenue neutral, so that it wasn't a huge impact on the on economic income coming in that the U.S. needs to run the government. So we have to look at that aspect and also understand that after 10 years, a lot of these provisions are going to expire. There's what's called a sunset provision, and some of these are going to happen even in 2025. So we're going to look at some impact there as well. Now, this just shows income tax rates between 2017 and what's going to happen over the next, well, including last year to 7 years. This is going to be the first time we're doing our taxes with the new tax rates. And what we're seeing here is that the tax rates have come down, as we could see. So when we're looking at our different income brackets, being in the administrative positions that you folks are in, we're probably sitting somewhere in one of these two brackets here. So folks that were in the 25 or 28% income tax brackets are now down in a 22 and 24% income tax bracket. So what it means is that your highest effective tax rate has gone down a couple of percentage points. So does this automatically mean more money in your pocket? Well, it has meant in 2018, you should have seen more money in your paycheck because less of your income is, or more of your income is being taxed at a lower rate. So we're paying less taxes. So everyone should have seen their take-home pay increased throughout 2018. However, when it comes to doing your taxes, that's how we're really going to see the impact, if there was an impact, of these new tax rates. Also, for anyone that has investment income outside of retirement plans, if you're owning any stocks or mutual funds that are not what we call tax qualified, capital gains rates, these are the taxes that we pay when we sell an investment. So if we have some stock in, say, Verizon, I pick Verizon because I could see their building outside my window here. If we have stock in Verizon and we sell that stock and we have a gain over more than a 1-year time period, we're paying capital gains tax on those gains. And most of us, I would say, on the phone are somewhere in this 15% bracket here. So we're paying 15% taxes on those gains. So it doesn't add into our income. We pay a separate line item on those taxes there. And if anyone is fortunate enough on the phone to be in the over $479,000 income tax bracket, then you're paying a little bit extra. But if you are there, then I don't want to hear complaints that you're paying an extra 5% because you're making plenty of money there. All right, so what we're seeing also, the big change is we're seeing an increase in the standard deduction. So this will impact people in a couple of ways. Number one, what we used to do here is we used to decide, and what we'll still do when we do our taxes is decide, do we take the standard deduction or do we itemize our taxes? And what we're doing here, or what the government has done, is they've taken this $13,000 standard deduction for married couples. It's half of that if you're a single filer, and they almost doubled it to $12,000 and $24,000. We don't see many people file as head of households, but that number is somewhere in between. So usually in the past, if we had more than $13,000 of itemized deductions, this would include real estate taxes, it would include mortgage interest, it would include perhaps student loan interest, charitable deductions, anything of that nature. If it was over $13,000, which wasn't really hard to get over for some folks, then we would itemize. If it was under that amount, then we would just take the standard deduction. Well, now that that number went up to $24,000, they're projecting that a lot less people right now, or in the past, about a third of people, as you see here, itemized their taxes or their deductions, and they're looking at maybe that going down under 10%. So for some of you, it could make filing your income taxes a whole lot simpler because you won't have to keep receipts and look at all your deductions and all that good stuff. Now, if anyone has a side business or any type of side income, or your spouse that you file with is self-employed and has some deductions, they'll still want to do that. But for people that are mostly on a W-2 income, then it could make things a lot easier. Our recommendation, and I will throw out a full disclosure here in that I am not a CPA. I don't do my own taxes. I have someone do them for me, and I'm not going to tell you exactly how to do your taxes. But what I would say is, in knowing these different differences here, maybe you want to have your tax person, or if you do it yourself, run it both ways. See what happens if you itemize, and see what happens if you take that standard deduction, and see what'll work out better for you. Understand too that the personal exemptions are, they call it suspended. So if you have dependents and you're used to taking, so I've got 2 children myself, and I would take that personal exemption that would get added on to the standard deduction, that's gone. So for me, that would be $8,000 plus the 13, getting me to 21. I'm still in better shape by using this new standard deduction of 24,000. Michelle and I were just chatting. One of my colleagues has 7 children, and that $4,000 exemption for him, I mean, that's pretty big that he's missing out on. So, you know, he's going from almost a $40,000 deduction down to 24. So this is where, in some cases, this new tax bill might not help him in that regard. So moving along here, a couple other deductions that for people that will still itemize. This SALT deduction was a big one. It was in the news for quite some time. For upstaters on the phone, might not have a huge impact, but for folks that are downstate, certainly would. Where income taxes, sales tax, property taxes were the big one. Deductions capped at $10,000 for that. So that will have an impact on people that itemize or not. Mortgage interest deductions, again, we don't see many $250,000 or $1 million homes up where I'm at in Syracuse. But again, I don't feel so bad if someone's got $1 million house. And I'm joking when I say these things. I want everyone to have as much money in their pocket as possible as a financial advisor, but I just got to keep it light a little bit here. And then there have been a change to unreimbursed medical expenses, which quite honestly, we don't really see a whole lot. Most times people that are working don't have to worry about itemizing their medical expenses. So in a nutshell, a couple of others, charitable contributions. Now, this is where you may have seen in the news, well, what's the big deal? Now we can't deduct charitable expenses. Well, again, if you itemize, you're itemizing those charitable deductions that you're making, or charitable contributions that you're making. So if you're under that $24,000 and you're going to use a standard deduction, then no, you will not be writing off your charitable deductions. So what some people are doing, if people make sizable charitable contributions on an annual basis, so let's say that people are usually making $3,000 or $4,000 in total charitable contributions, instead of making those deductions every year, they're saving up. So they're saying, well, I'll every 3 years, instead of doing $3,000 per year in a charitable contribution, I'll save up, and every 3 years I'll do $9,000. So that $9,000 charitable contribution might allow them to itemize deductions, because then their deductions will be over that $24,000 limit. As you can imagine, it takes some planning on that part, but it's also a challenge to all those charities out there that were relying on those annual contributions. Now they're stating that, hey, we might not get a lot of money coming in, and sure enough, they have seen some drops in donations in 2018. So it's tough for them. Casualty losses have gotten stricter as well. And then there were a list of itemized deductions that were subject to a floor of 2% of your gross income. And most of those have been repealed as well. One of them or a couple that impact us, whoop, wasn't supposed to do that. This one here, this investment advisory fees. Some folks are paying an investment advisory fee. They might be paying a financial advisor a couple hundred or a couple $1,000s a year to on a retainer basis, like you would pay an attorney. If you were doing that, then you're not able to deduct those expenses any longer. If anyone's out there paying alimony, there are some changes there. And then the AMT, the alternative minimum tax, which was put out there years upon years ago to tax rich people more. For all those decades, they never increased the amount. So way too many of middle America was paying the AMT, myself included. I was never happy about it. They have finally changed the numbers on the AMT. So hopefully, if any of you were paying that alternative minimum tax, you will not pay that any longer. Going forward now, what is surprising as we go into what's going on now and into the future is that, yes, taxes are actually getting lower, and they have been getting lower for the past, say, 40-ish, 45 years or so. This graph just shows the top marginal federal income tax rate over the years in the United States. And you could see the top rate throughout the 40s and 50s was about 90%. So the top rate that we have now, which is 34%, imagine it was 90%. And it's been coming down pretty consistently over time. And right now we are in a very, very low, and you can see outside of Depression era, we are in a very low, historically low income tax rate environment. Now, what does that mean for us? If we compare income levels, again, just making an assumption on the phone here that income levels are somewhere in this $100,000 to $200,000 range, it puts us in the 22 to 24% income bracket. However, if you look at 2018 tax rates, what's important to note is your effective tax rate. So many folks will say, well, I'm in the 24% tax bracket, so that means I'm paying 24% federal tax on every dollar I make. Not exactly, because as you can see here, because it's a graduated system, as we saw in a previous slide, you pay 0% on the first sum of money, you pay 12% on the next sum of money, you pay 22% on the next sum of money, and so forth. What's important to note is your effective tax rate. So on a $200,000 income, you're paying roughly $36,000 in taxes, so that's an 18% effective tax rate. Now, we do have to keep in mind this is just for federal tax. For those of us, well, all of us are in the great state of New York. If we're in this a $200,000 income level, we're probably paying about 6% in state income tax. So that effectively pushes us back up to 24% anyway. So call it 6 of one, half dozen the other. We're still paying about 24% taxes, but important to note that our effective tax rate from a federal standpoint is never our tax bracket, although at the lower levels, it can be pretty close. How we compare globally, I always laugh when I see this slide because a lot of times we hear celebrities and rich folks say, well, you know what, if this continues in the US, then I'm moving overseas, I'm moving to England or whatever, moving to Canada, and you're going to go ahead and pay more tax if you go to one of those countries. So believe it or not, in the United States, we actually pay less tax per household on average than our Canadian and our UK counterparts. So sometimes just not too bad to be living in the United States. And we'll see New York is actually a pretty good state for retirees in some respects. However, going forward, we have to look at this and we have to say, well, what are tax rates going to look like today, but also going forward? What happens when this Tax Act changes potentially just now 6 years from now in 2025? Well, what are taxes used for? Well, taxes are used to pay all the government services that we take advantage of. And when we're looking at deficits and surpluses, you could see that the U.S. is operating at a deficit, has been for quite some time. On average, we operate about 2.7% deficit here, and deficits are projected to increase over time. So as we get out here to that 2025 time frame, well, what's going to happen is that we're going to owe more money than we're taking in still, and what's the best way to get that money back is by increasing taxes. So many people are forecasting, well, are we going to see an increase in our federal tax rate in the future to help pay for all of the services when we look at not only the deficits, but we look at state and government payrolls going down. We look at tax caps on property taxes like we have in New York State. So whenever the government is taking in less revenue from other sources, the ability for them to tax income is a huge opportunity for them to bring income in, and it's something that we could see them definitely trying to take advantage of going forward. So again, looking at expectations of some of these provisions expiring just about 6-7 years from now, and the sunset date is going to impact a lot of these numbers that we're talking about. So will taxes go higher in the future? We'd love to say we know what's going to happen, but of course we don't. But the challenge is then how do we prepare? How do we take advantage of low tax rates today, but also how do we prepare for the expectation of a higher tax rate in retirement? Well, let's look at an example here. And for those that were at the conference that sat in on my presentation, number one, I apologize, you have to listen to me twice. Number two, I apologize that this will be a little duplication, but what we have here is if we're looking at an income need of $100,000 in retirement, using just a basic formula for our pension, final average salary of $100,000, 30 years in service times 2% for a tier 4 member. So a pension is going to be 60 grand. Social Security between ourselves and a spouse will be about 36,000. So, all right, to make up the extra deficit, we could just subtract $4,000 from our 403B plan. That gives us a total income of $100,000, and we're living somewhere on the intersection of Easy Street and Comfort Street, so we're feeling pretty good about ourselves right there. However, we have to pay our uncle. Uncle Sam is everyone's favorite uncle, of course. So when we look at the New York State pension, what is the net amount that we're getting in our pocket? Number one, if we're looking at any type of survivor benefit, they're going to run about 10% on a survivor benefit, and this is those joint options that we have access to. So if we take that off, and then while we don't pay New York State income tax on our pension, we do pay federal tax, income tax on our pension, so that's going to take some money off the top as well. So our net pension is going to go down to 47 and change. We're going to throw in Social Security on there, but because of our pension income, some of our Social Security is going to be taxed. So 85% of that $36,000 is taxable. we're not paying 85% tax. We're taking 85% of the 36K, we're applying that to our tax bracket, and we're paying about $4,500 in taxes. So our total income, where on the surface it was $96,000, now it's down to $79,000. So taxes definitely play a part in our retirement income projections. Well, what does that mean? That now we're not $4,000 short, we're $20,000 short. And looking at taking out, so now we're in a 22% income bracket. So what that means is that, remember I said our effective rate is different, but now any dollar that we're taking out of our 403B, we're paying 22% income on the money coming out. Plus we are paying 6% income tax to New York State for retirement plan distributions. Now, New York State does not tax your pension, and they do not tax Social Security either. So it makes it tax advantageous for those of us living in New York State in retirement, but they are going to tax money that we take out of our retirement plans. So to get that $20,000 out, we're going to have to take out $28,000 from our 403B plan. So that definitely changes things a little bit when we're trying to get to that lifestyle. So again, to generate $100,000, we actually need $128 in total income. So maybe we're heading to a dead end there if we haven't done enough planning for it. So what do we do? One of the options we take a look at, we can't avoid taxes on our pension. We can't avoid taxes on Social Security because we have that pension, but can we tax diversify our retirement savings? So when we look at what has taxes attached to it and what does not from a retirement planning standpoint, your 403Bs, if you have had or your spouse has a 401k or 457 plan, traditional IRAs, or any other non-tax advantage stocks or mutual funds, we're going to have to pay income tax on those dollars. Well, we can get tax-free Roth accounts, Roth 403Bs, Roth IRAs, dividends on municipal bonds, or life insurance retirement plans, we call them, where we're able to actually tax shelter money in a life insurance plan. We could get that money out income tax-free. So to use the example before, if we're $20,000 short, anything on the right-hand column, we take out $20,000, we get $20,000. Again, the dividends on the municipal bonds. If we sell the bonds, then it goes under that category in that capital gains tax treatment. However, most people have the majority of their retirement income savings under this column here. So we look at, well, should we take a look at some tax-free opportunities on this side here? Common question we get, well, Greg, tell me more about these Roth IRAs or Roth 403Bs. So when I talk about Roth contributions, I'll actually, there are different provisions from an IRA to a 403B. One thing I encourage everyone to do is to look at their school district's plan. Most of them have a pre-tax 403B. Very few of them have an after-tax 403B. However, it's extremely easy to set up a Roth 403B in your districts. And if you need help with that, reach out to us and we could talk to the powers that be in the district and explain it to them. But it would give you an opportunity. You would save after-tax dollars today, but all your distributions would be tax-free coming out. So why does that make sense? Because remember, in the past, we said we're in a very low income tax rate environment right now. We're paying less in overall income taxes than our parents and our grandparents paid when they were working. And I personally expect that tax rates will go up over the next 20, 30 years when I'm retired, then go down. So if I could save some money after tax today and say, maybe I'm paying an extra 18, 19% in taxes, but I could save 25 to 30% down the road, that could be advantageous for me. So on a Roth IRA or a Roth 403B, again, contributions are on an after-tax basis, but I don't pay taxes on money coming out. Whereas on a traditional IRA or a traditional 403B, sometimes we'll call them, it's pre-tax going in, taxes paid coming out. Some additional benefits. Now, this is more for Roth IRA accounts. Sometimes we could get access to our money beforehand. We can make contributions whenever we want to. This works out for some folks that continue to work in retirement. So a lot of folks I just ran into a client yesterday who was a school administrator. He's retired and he's an adjunct professor at a college right now. So as long as we have earned income, we could save some of that income into these plans, which is nice. And I'm sorry, we don't need to highlight every single bullet point here, but we could definitely help you if you have more questions on this. But as far as what to choose, so what makes sense for one over the other, traditionally speaking, those that were younger that had more time for money to grow, a Roth IRA is more advantageous for them because there's all that time for that money to grow and have the money come out tax-free. If someone is within 3-4 years of retirement, chances are that maybe a pre-tax plan is better for you right now to lower your taxable income today, but it's going to depend on a lot of different factors. Important to note that with this, say, bullet point right here, with a Roth IRA, you don't have to take minimum distributions like you do from a traditional IRA because there's no tax due on the money, so the government doesn't care if you leave it in there or not. But Roth 403Bs follow 403B guidelines, and you do have to take money out at 70.5 of those. There are just some wrinkles in there, differences between the two that we do have to be aware of. Major benefit of a Roth 403B is that with IRA plans, there is a maximum contribution number here, and it's $5,500 to $6,500, depending on if you have an opportunity to use a catch-up contribution. But with a Roth 403B, you could save up to the $19,000 or $25,000 maximum that 403Bs have. So definitely allows us to get a lot more opportunity into that tax-free bucket. So how to set one up? Pretty simple. If you have a Roth 403B option, or again, you don't, let us know. We could help you out. If you're an individual, you just work with someone like me, and we could help you set up a Roth IRA plan. So pretty easy to do, easy to get set up. And this just shows who should consider opening one. I would say I would highly recommend for anyone, if you have a non-working spouse, in many cases, you can make a contribution for them in a Roth setting. We talked about retired individuals if you have a little side job or something, but if you have children that are earning any type of money, they can contribute into a Roth IRA as well, as long as they have any type of income. So they do some summer work, they do any type of part-time job, they can contribute 100% of that income up to the IRA limit. So if you've got a child who's doing a little bit of work and you want to help them out a little bit, say your kid makes $2,000 in the summertime, if they save the money, or maybe you just do the contribution for them, put $1,000 for them into a Roth IRA, you do that every year for 15, 20 years, and all of a sudden they're going to thank you for it way down the road. So an opportunity that you folks should consider. So we're pretty much right up on time here. How to get a hold of us. This is the map based on the region that you're in. There's the contact information there as well. Obviously, we'll answer questions right now. I'm sorry, I went a little bit long. We went right up to 12:30, but I'll definitely stick around for a few minutes if anyone has any questions.
Okay, Greg, yeah, we have two questions. The first is, in retirement, in addition to no longer paying New York state tax, we also no longer have Social Security, Medicare, union dues, 403B taking out of our pension pay, correct? So then your example of net income is leaving out some important factors.
Well, if we're looking up there, what I looked there is, you're right. The person is right in that, yes, we're not paying Social Security tax, we're not paying Medicare tax, we're not paying into a 403B. What I was looking at is just someone who needs $100,000, who wants $100,000 in retirement income, and where it's going to come from. So what I was not doing, and then maybe this was a communication error there, I wasn't saying that, all right, you make $100,000 before you retire. Now, what does it look like afterwards? What I was saying is that for someone who wants $100,000 in retirement income net, what are those income sources going to look like before tax and after tax? A lot of times people will say, well, I won't need as much money in retirement time because of those things, because I'm not paying that 6.2% Social Security and 1.45% Medicare tax. yes, I'm not saving into my 403B any longer, but sometimes costs go up. Sometimes we have more travel expenses, or we might have more medical expenses. You never know. So the example there was just a simplistic one to say, I want $100,000 in income based on a pension of 60 and Social Security of 36. What is it actually going to look like net after taxes?
Okay. So one more question. I heard that in New York State 403B withdrawals are not New York State taxable. Is that true?
They may or may not be. It really depends on a few different factors. So the way that the law actually reads is that pension income in New York State, if it is in substantially equal payments over time up to $20,000 per year, would not be taxable. However, there's a few different caveats to that. The most important one for school district employees is that many times people will retire, say at age 55, 56, before 59 and a half. So the rule applies if it's a substantially equal payment, and some will say, well, they can't prove when or how I'm taking it out. So what that means is that if you take out $1,000 or $1,500 per month, then that's a substantially equal payment each month, then it should be tax-free. But it does not apply if someone just takes out, say, $10,000 at a time. At least it's not supposed to. I'm sure any accountant will have you take the deduction anyway, but technically you're not supposed to. The other thing is that it doesn't apply to people that are under 59 and a half. So if someone has their 30 years in at 57 and they retire and they're taking distributions from the 403B, it will be subject to New York State income tax because the rule is 59 and a half or older. So there are some quirks in that rule. By and large, I would say, yeah, in most cases, people could probably get around it and get it, but there are some instances where it's not available. And I put it in there just to highlight the worst case scenario. But, if you look at the numbers and you say, well, I'll get around it anyway, that's fine. But, it's 6% or so. So it's, it definitely could make a difference, but I would say that it's not an automatic.
Okay. All right. I think that's all the questions we have. That was a lot of good information. So everyone, you'll see that Greg posted the contact information for your local AXA representative on the screen. So you can contact Greg or anyone in the state that might be in your area. The session has been recorded, and I will send all registrants a link to the presentation so you can refer back to it. And also, again, have this information. So I think that's it for the day. Thank you, Greg.
Thanks, Michelle. Thanks, everyone, for joining on.
All right. Bye-bye.